Greetings, and welcome to Cyber Focus, your source for timely international business strategy. My name is Brenda Bailey-Hughes, and our guest today is Professor Greg Udell. Greg is the Chase Chair of Banking and Finance at the Kelley School of Business, Indiana University. And prior to IU wooing him here in 1998, Professor Udell served on the faculty of NYU, where he directed the William Berkeley Center for Entrepreneurial Studies at the Stern School of Business. Greg has consulted with organizations such as the Board of Governors, Federal Reserve System banks, and the World Bank. Professor, thank you so much for joining us today.
Brenda, thank you for having me.
All right, you have some interesting research that you're working on right now, a working paper, yes?
Mm-hmm.
Can you summarize for us in layman's terms what your findings are?
Well, the research primarily focuses on whether there was a credit crunch in Eastern Europe, although this is certainly a question we're asking here in the United States and more generally in other parts of the world, like Western Europe too. And so the fundamental question, is there a credit crunch, and particularly is there a credit crunch in the small business market?
All right, our viewers are going to want to know that. Is there a credit crunch in the small business world?
Well, this particular piece of research that I'm talking about now is in Eastern Europe, and although I'm doing research in other countries, including the United States, to try and answer similar questions. But Eastern Europe is a particularly interesting case because the crisis didn't start in Eastern Europe. So if there's a credit crunch in Eastern Europe, how did it get there?
And if it didn't start there, why did you choose to study that area?
Well, I've had a long interest in developing economies and the banking systems in those economies, and particularly access to credit by small businesses. And that's why I've been involved with a number of different projects with the World Bank, focused on various aspects of that issue. So this is part of a long-held interest that I've had.
Okay.
And
But I had interrupted you. You were saying that there.
Well, so the more specific question we're asking is how, if there is a credit crunch, that's question number one. Question number two, if there is in Eastern Europe, how did it get transmitted there? And three, did it get transmitted there through the banking system? And what's interesting about the Eastern European banking system, although this is also true in Latin America and South America, is that the banking system in Eastern Europe is basically now mostly, although there's significant variation across countries, foreign-owned. Western European banks, and in a couple of cases, U.S. banks, now own most of the banking presence in Eastern Europe.
Interesting.
And so one transmission mechanism could, in fact, have been through the banking system, in the sense that if foreign-owned banks behaved differently and were affected because their parent banks in Western Europe and the United States, who got in trouble buying toxic U.S. assets, decreased their supply of lending in Eastern Europe, then essentially the credit crunch we're worried about in the United States was spread through Western Europe to Eastern Europe. And that in and of itself, I think, is a very interesting question, although this study also speaks to a more general issue about who is affected most among the small business population.
Okay, hold that thought. I want to come back to that.
Okay.
So you asked three very specific questions. Is there a credit crunch in Eastern Europe? If there is, how did it get there?
Right.
And did it happen because of banking? And it sounds like yes is the answer to number one. There is a credit crunch?
We certainly find evidence consistent with a credit crunch in Eastern Europe, yes. Where a credit crunch is specifically defined as a contraction in the supply of credit by the providers of credit, and of course the big provider of credit to small businesses are banks.
So if I'm a small business and I have suppliers or customers in an Eastern European country who are dependent on a bank line of credit, what are the implications here for me?
Well, the implications there are fairly straightforward. Those customers or those suppliers will face credit constraints because of this that they didn't face in 2006 and 2005. And so if you're a business in the United States working with either customers or suppliers in Eastern Europe, or to the extent that this applies elsewhere in the world, like Latin America and South America, you should expect that those relationships you should view those relationships in a different context now. That your customers and suppliers may be credit constrained where they weren't before.
So there is a credit crunch. How did it get there? Through the banking system, buying, because of the foreign owned, potentially Western Europe or U.S. parent banks.
Right. I can be a little bit more specific than
go
that.
ahead.
And what we did is we had data that allowed us to look at the banking in more than 1,000 local markets in Eastern Europe and differentiate between those markets that were foreign-owned in terms of their banking system or domestically owned. And we also had information about whether those foreign banks who had their subsidiaries in Eastern Europe, to what degree were they affected by the problems essentially in the mortgage business, the toxic assets. And a lot of these foreign banks in Eastern Europe are Western European banks. Most of them are.
Okay.
But those Western European banks got burned in this crisis because many of them bought what we've now come to call U.S. toxic assets, mortgage-backed securities, subprime mortgages.
Okay.
So the channel basically runs right across the ocean and through the banking system.
So that's the channel of transmission for the credit crunch.
For the credit crunch,
to
exactly.
Eastern European
To Eastern
countries.
Europe, right.
Would it apply to other regions?
Well, it could. Now, it
This
could.
transmission?
Yes, it certainly could apply to regions that are where the banking system is foreign dominated, and so here the big concern is developing economies, and so in the U.S. that particular issue of foreign-owned banks is not a huge issue because most of our big banks like Citibank, Chase, Bank of America are they're domestic banks. They're not foreign banks, although we certainly do have foreign banks in the United States.
Earlier you started to mention who is most affected by the credit crunch, and I think that will be of particular interest to our viewers because I think there's a general assumption that small businesses are more affected by the credit crunch. True? Not true? What does your data show us?
Well, one of the problems, and this is a related issue, is that studying the credit crunch and answering that particular question, which businesses are affected more, is ironically more difficult in the United States.
Why would that be?
We have poor data. As a country, we have decided to invest less in data related to the small and mid-size firms than other countries have. And so the Federal Reserve, for instance, in 2007 discontinued the best data set that we had, which was a survey they conducted every 3 years, extensive survey of small businesses, because they felt, well, we knew everything we needed to know about small businesses. We'd done the survey through a whole business cycle.
Okay.
That survey would have been conducted right in the middle of the credit crunch. And also more generally, we don't have something called the credit registry. So the best data on small businesses come from places like Spain, Italy,
Who
and
have
Argentina.
These credit registries?
These are credit registries.
Have we had one in the past?
No, we don't
No,
have
we've
one
never
in the
had
United States. We've never had one. The closest we have is a private company called Dun & Bradstreet that generates information, credit information on businesses in the United States, but it's much less complete. Now, these are expensive. I mean, you don't get data for free, but virtually every loan that's extended in Italy gets posted in this credit registry, and the same in Spain, the same in Argentina. So those countries have a lot of data where we can answer questions specifically about who is going to be most affected.
Would that data be, and I want to hear what the answer to that is,
Right.
but would those answers potentially be applicable to places other than where the data was actually collected?
Yeah, so I think that even though we're studying small businesses in Eastern Europe, and the lending environment and the business environment is very different. Some of the things we're finding there, I think, would apply here in the United States. And generally, I would say, consistent with sort of abstract theoretical work that we've done on access to credit, the more transparent a firm is, the less likely it is to be affected by the credit crunch. And the more opaque that firm is, the more likely it is.
Describe what transparency and opaqueness actually translate to. What might that mean?
So I'm also, in a former life, a banker, and I'll describe it in sort of practical terms. Okay. A transparent company is a company where a loan officer can sit down with the CEO of the company and pretty much understand what's going on in that firm, because there are audited financial statements. The firm is large and has very public interaction with the business community as well as the broader community. Smaller firms in general are much more opaque, where when a loan officer sits across the table from an entrepreneur, the entrepreneur whose financial statements are not audited is likely knows much less about the profile of that company, including its risk profile, than the entrepreneur. So in an opaque banking relationship, that bridge has to be gapped, and opacity then describes how big that bridge is, essentially. So in one way we can think of that is that small firms are more opaque than large firms. Another is that firms in general that have more tangible assets are more transparent.
Okay.
Like equipment, accounts receivable, inventory. So having lent, for instance, to advertising agencies, small advertising agencies, those are opaque firms. Unless you can judge how good an advertisement is, if you're not in the industry.
I'm a small business with fairly non-tangible or intangible services or products. What do I do during a credit crunch? Because you're saying I'm going to be hit much harder.
Well, here this is a universal question. This is not specific to my study here. I might mention this study that I'm talking about here is conducted with my co-author Alex Popoff at the European Central Bank. So, but more generally, the more opaque you are, the more important your relationship is with your banker. And so there is evidence, mostly from other countries again, that in a credit crunch, that those companies whose relationship with their banker is stronger are less likely to be affected by the credit crunch.
Interesting.
So this has real implications. So when banks fail, think Irwin Union and our local community fail, relationships may have died. Small business relationships may have died with that failure. And for opaque companies, that could be more severe. It's very difficult to test that with data, where I can say that, yes, I'm sure that's true, I can prove it statistically. We just don't have that kind of data in the United States. But studies in other countries where we have that kind of information, as well as sort of our general knowledge of the banking system, I think the hypothesis that that's true is probably valid.
This might be a very naive question, but the fact that my relationship with my banking institution becomes more important the more opaque that my company is.
Right.
Would there be an indication? To me, building relationship is easier if I'm working with a small institution. Would there be any? Is there any connection between the size of my bank and my ability to?
This is, in my area of research, one of the most interesting questions, and sort of banking theory tells us that that's true, and that the evidence seems to suggest that relationship lending is likely better delivered by smaller community banks. So I've done it 2 conferences actually, one at the Chicago Federal Reserve Bank and the Federal Reserve Bank of Kansas City in the last 10 years on this very subject, the importance of community banks. And so now it may be that going forward as our banking system consolidates and we become more big bank dependent, that big banks figure out a way to do relationship lending. But I think the evidence, and we do have some evidence on this in the United States, is that that's true. The community banks are better at that. And so the loss of community banks, which affects right here in Bloomington, affects us right here in Bloomington, may be significant to the to credit access by small businesses.
That is interesting. So we've heard a couple of implications for the small business owner on bridging the gap if I am a rather opaque business, considering who my bank and what size my bank might be. Do you have any other closing words of wisdom for our viewers related to your research?
Well, I think staying alert and being aware of this. So
what are the questions I should be asking? How do I stay alert?
Well, I think if you're a business and you're getting back to Eastern Europe, which was the focus of the study that we've been mostly talking about here, I think being aware of what's going on in Europe in general and what's going on in Eastern Europe is going to be important to you because, and Europe is at severe risk right now, not just Eastern Europe, but all of Europe, and even the euro is at risk. And so I think being informed and being sensitive to this, because if you have customers there, you're going to have receivables, and if you have suppliers, and they may need to get paid quicker because they don't have access to banking. So it is going to affect you. So I would say being informed is important.
Great. Well, thank you so much for your time. It's been
My
a pleasure
pleasure
to work with you. Thank you for tuning in. I hope you got some great advice that you can use. If you have topics that you'd like us to discuss in future Cyber Focuses, just reach out to the International Center for Business and Education Research here at the Kelley School of Business.